Welcome to the India Fintech Diaries, the only podcast focused exclusively on the Indian fintech market. I'm Elroy.
And I'm Hemant. In each episode, we dive into the latest trends, ideas, innovations, business models, and personalities that are shaping India's fintech landscape.
We also invite amazing guests who are innovators and industry players that are driving the change that is helping make financial services more modern, innovative, and inclusive in India. Come join us as we explore the changing landscape of fintech in India. Welcome back to another episode of India Fintech Diaries, where we bring you the latest insights, stories, and developments from the Indian fintech ecosystem. I'm your host, Elroy.
And I'm your host, Hemant. As always, we are happy to present a special episode with the Digital Lenders Association of India, just after the recently concluded Fintech Conclave. Joining us today is Anuj Kacker, co founder of Freo, a company that's doing incredible work in helping India's middle class manage spending, borrowing, and saving. Anuj, thank you for joining us.
Thank you guys for having me.
Pleasure, Anuj. Anuj, recently you attended the DLAI Fintech Conclave, which is a major event for the industry. Can you share some of the key themes and discussion that stood out to you this year? Anything particularly exciting or surprising?
Yeah, I think this year, given all that's been happening in the industry over the last 6 8 months, we were all eagerly awaiting to exchange notes. It's a great place to be because you meet everybody from all your banking partners, NBFC partners, your capital partners, your debt partners, and other distribution partners. All of them come together under one roof. So it's really good to have a discussion which ranges across business, policy, future, how was the past, because it's also close to the year end, right? This is the last quarter for everybody, so everybody has a
That's
fair
right.
sense of what it's going to be. I think that on the pure play unsecured lending side, this year probably will be flattish. Given that there's been a little bit of a slowdown in the overall unsecured lending piece. So I think that's something people were going to be a little bit cautious about this quarter. Hopefully, I think next year they probably will be back to some sort of growth. I think that is something that stood out. The other thing that stood out was a lot about how you can't build a business in any kind of regulatory arbitrage space. So either
Right.
compliance is either a binary, it's a one or a zero. So either you're compliant or you're non-compliant, and I think I said it somewhere else as well that either it's not just good enough to be compliant in letter, but in spirit as well. And I think a lot of founders and early stage companies who start with that mindset and those guardrails will innovate and figure out what works for them. A lot of the guys in the past, where all of us were, doing whatever we could do, and then maybe a lot of some people would have stayed, straight away, and now these guardrails have been put, so now they're figuring out how to come back. Some will survive, some will not survive. So I think a lot of the conversations also around that sustainability. The big theme was also getting to ensure that businesses are run in a profitable manner and they're bottom line positive. So I think blind growth chasing is was not something that was discussed. Everybody was okay doing, like, let's do lesser volumes, but let's do it in a sustainable manner. The margins are under pressure right now, given that the cost of capital has gone up. And I think the final piece that was interesting was this entire confluence of sorts from
Right.
getting not just the lending piece, but interviewing payments, insurance, wealth, and for consumer and for business alike. And everybody has a different stage of doing it. But given that a lot of people have been around for a few years, they have a large base. So you've done a product A, you've done well. Now you think about product B and C. So a lot of that bottom line positive work can come from the minute you start cross selling. So I think a lot of the conversation was around that as well, and stalwarts of the industry spoke about this weaving insurance, wealth, payments. Although you don't make money on payment side, like there's no interchange on UPI or MDR for that matter. But there's a way that you can acquire customers, give them some value, so that helps you keep your costs down. So I think this was the fourth interesting trend that we heard. So that's maybe a summary of the conference.
Those are some really great insights, Anuj. And as always, the DLI Fintech Conclave always brings about very interesting, forward-looking discussions as well. Now, speaking of buzz, consumer finance in India has seen an explosive growth over the past 5 years. Anuj, from your vantage point, what do you see are the biggest changes in this space over the last 5 years? Which segments have experienced the most significant shifts in consumer behavior?
Yeah. I think Elroy, the last 5 years will include COVID as well. So I think maybe I will stick to post-COVID because pre-COVID was a different
Right.
world, a different era in some ways. And immediately the year after COVID, at least the lending industry saw the maximum amount of headwinds. Right? I think there was a moratorium that was introduced, and people were unfortunately lost their jobs. They couldn't pay back, so that went through a little bit of a upheaval at that point of time. But after that, I think it's seen a little bit of a boom. I think the big shift there was that a lot of people figured out that maybe credit is the way to use that money to get things that they wanted, which they probably could not have.
Right.
And I think the accessibility of getting credit, which became so easy, whether it became on the app or the web or like 10 clicks on an app or in 5 minutes. So I think a lot of that sort of drove the adoption. I think
Okay.
the second point is that, and related to the first point is, and what helped was the entire DPI thing. So on a click of a button, if you could get my KYC done, I didn't have to send somebody to your house. The click of a button, you could check you take a video of me and do a facial recognition and see am I a fraudster or not, and so many other fraud tools that came up. You could do an account aggregator and get my bank statement instead of mailing you or WhatsApping you my bank statement, which was happening in the past. So a lot of that entire the tech stack enabled you to be able to do this 5 minute thing, and that sort of helped proliferate all the fintech companies and the fintech apps and NBFCs to be able to reach the masses. I think that sort of also drove up the entire consumer lending piece. And the third thing I would say is that there was this entire goal of financial inclusion, and the
Correct.
banks would go after a certain kind of segment, maybe slightly premium segment with, and I say premium not from a credit risk perspective, but from a income perspective. The guy who earns
Sure.
30,000 rupees also will be a 750 Civil Plus or so 4 plus. So I'm not discriminating there, but I'm saying more maybe on the income side. But then there was the NBFCs also were going to the next level of segment. Fintechs were helping them take that to the masses. The stock market was also booming, so everybody was being able to, fintech, all the NBFCs, etc. They were getting capital, so they were going to deploy it. So it sort of helped that there was a financial inclusion goal as well. So I think that last 3 4 years has seen all these reasons have helped it grow significantly. The only difference I would say is that I think the this year, which is the maybe the last 6 8 months, I think there's a little bit of a slowdown. So I wouldn't say that the last 5 years have been on an upswing. I think they were, and now tapering a little bit, and then I think some course correction will happen, and then we'll see maybe a boom cycle again after some time.
Interesting, very interesting. Actually, Anuj, in my day job, actually, I work with a lot of financial services companies and fintechs, helping them attract and acquire customers. And over a
Yeah.
period of time, we have been seeing a big shift in the way a consumer behaves. Considering, of
Huh.
course, there have been so many drivers, right? You touched upon that. Higher access, there was COVID, the newer generation coming in, the way they think about money is different. Then, for a lot of things, they had to borrow because there was no money available. In fact, in one of the cases, we saw people borrowing for buying a 12,000 rupees phone, on which 10,000 was all entirely borrowed. Only 2,000 was paid in cash. So, as you see
Yeah.
this, if you can help us understand a bit more on this shift in consumer behavior, and I understand it will change by the category of the customer we are looking at, whether it's a pure millennial existing to credit or a millennial new to credit or any of that. So if you could get a little deeper from financing point of view, and because Freo also serves on borrowing, saving, spending, everything else, uh, good to get your views on the shift in behavior.
Yeah, I think the largest shift in behavior has been this entire shopping online, honestly.
Right.
this financing offline has been existing, right? Bajaj is the king at that space, and now Home Credit and so many other Tata Capital, etc. They do a good job of doing it offline. So the minute you shifted that to online and you said that, hey, my pipes are running online into various apps and distribution plays, could be a food ordering app or could be a travel app or my own app for that matter. But the cost of delivering that doesn't matter, right?
Right.
If I buy a 5 rupee thing or 500,000 rupee thing, the cost is the same in some ways for me to deliver that product. So maybe make it accessible for the smallest unit possible. Why, restrict it to only say 50,000 rupees? For example, the entire offline financing space, the average ticket size tends to be in the 50,000 ish kind of mark, right? Maybe a little bit higher or lower. I'm not sure about that. But it's for TVs and fridges and those kind of things, or even hypothecated, two wheelers for that matter, which is a little bit, in that same range. But if my cost of delivering that is going to be the same online, because I don't have to put a person, I don't have to have physical paperwork, so I don't need to ensure that I have a higher ticket size. Why not get millions and millions of customer do 1,000 rupee transaction or a 10,000 rupee transaction, and I'll finance that. So I think the biggest shift happened over the years because it became very, very accessible on a digital platform. And everybody was innovating along with these, whether it's white goods like Samsungs of the world or iPhones of the world or offline stores, and this entire proliferation of the entire D2C ecosystem. And obviously folks like the ticket travelers and food travelers existed from before
Right.
this D2C. If I put all of them together into one bucket of selling commerce online, I was able to finance it. So, if it works for buying TV, why does it not work for me buying a burger or a pizza? So I will finance even 500 rupees. So I think that is the one that sort of really drove the adoption significantly. And that has been a big mindset shift, right? I mean, I don't think that my parents would be okay saying that, I'll buy 1,000 rupees worth of goods, I'll finance it, and maybe at the end of the day, I'll pay 1,050. मैं क्यों वो 50 रुपए extra क्यों दूं? And I
Yeah.
think that's always been a fair conversation that all of us have had. As Indians, we don't pay for convenience as much, right? We will probably walk to the
Correct.
store and not do that. So I think that has always been something that was driven by the younger generation to say, I don't want to get out of my bed, so maybe I'll pay the 50 rupees extra if I can finance it and order it through this app, and I'll play it back in 3 months. And I think the other thing also happens is that this younger generation that we're talking about who's probably driving this behavior, like you pointed out, Hemant, is that, I mean, their disposable incomes are probably better than what it used to be 10, 15 years ago.
Right.
So if my disposable income is better, I'm still unmarried and I don't have that many expenses, then I will my expenses, my money that will go into various aspects, right? So it'll go into buying good stuff for myself, maybe staying in a good part of the city, maybe traveling, holiday, and all of this can be financed, and all of this is done online by by this generation, this millennial generation. So, and I should be able to finance that, and where there was a huge amount of demand, supply followed, and innovation followed. So you could do one click process. That's what gave rise to this entire BNPL concept, buy now pay later. Although it has its own challenges, but I mean, outside India, Klarnas of the world and Affirms of the world and Afterpay of
Right.
the world that you could do it. So all of those things sort of came together, which has been driving this entire consumer finance. So even for a 10,000 rupee, I'm now able to finance it rather than just finance like a 50,000 or a 1 lakh rupee purchase.
Anu, just a related question on that. How do you see the rise of quick commerce actually changing some of this as well? Because while quick commerce initially started with really low ticket grocery type items, it's kind of late kind of migrated to larger ticket size items, including electronics and other white goods as well.
I mean, quick commerce is here to stay, as it's been shown. Whether this everybody can do it in a sustainable, profitable manner, time will tell. Some people were already doing it because they had economies of
Right.
scale. Some guys have come and disrupted it a little bit more. and we have to see whether they can do it at a profitable manner. Uh, but I think that your question is more around the financing side of
More around
things.
the financing side of things, because if I can buy an iPhone 16 now in 10 minutes, can I also get a
Yeah.
loan in less time than that?
No, see, the loan in 10 minutes has been existing for the last, I don't know, 10 years, right? Like
Right,
HDFC has been saying give it to you in 11 minutes if you're an HDFC customer. So I think the quick commerce part and doing a loan in 10 minutes is not related, in my opinion, because we have been doing it for like you on our platform and at Freo, you could have got it in like 3 minutes if you had all your
right,
details available to you on the spot. It's literally how fast you can type and have your documents ready. I think that part was sorted out like 7, 8 years ago. But if quick commerce is delivering the goods in 10 minutes, but if you're already like a pre-approved customer, so I guess they would have, if we work with a quick commerce company, we would take their base and say, all these guys have been pre-approved for say up to 10,000 rupees, just for argument's sake. So they will go
right,
and market to them that, hey, you can buy this for 10,000 rupees or 20,000 rupees and we'll deliver to you in 10 minutes because you've already pre-approved. Just click OK and give your consent, right? But I do think that even then, the way the laws are today, they still have to ensure that the KYC is done properly. There's a repayment, e-NACH, and e-mandate setup. So that just takes a little bit, maybe a few more steps.
yeah,
And then after that, delivery can happen in 10 minutes. And I used to do this about 7 years ago or 5 years ago. At that time, when I used to talk to merchants, the merchants used to say that, we want 70-80% of the customers who come to your platform through us get the approval. The KYC has to be done in an instant. Why do you need to take all these details? You do the NAT setup or the email setup outside of our system because they didn't want to compromise on the checkout or the commerce part of their app,
right,
right?
right,
And we ended up not working with most of them because that was not allowed, and B, that was very bad risk management. There are enough companies that blew up because of that. And today, that at least that is not the conversation because they all understand that you can't do this without the proper check of your credit bureau, proper KYC, proper fraud check, and proper repayment setup because that's not sustainable. We don't do all of this. So this might take 10 minutes to set up and do and etc. And then another 10 minutes to deliver.
I know, just shifting the focus a little, right? Let's move a little towards financial inclusion. Now, while you rightly pointed out, there's been a lot of significant progress that we have made as a country in terms of financial inclusion, but still there's a large amount of population that still remains underserved. So I just wanted to get your views on how the industry is addressing this, and are we doing enough to reach rural low-income consumers?
Yeah, I think Roy, this is like some of one of the challenges that the fintech industry might also be facing over the last year or so. Because I think the mandate that the fintech companies took forward was financial inclusion, right?
Right,
To be able to take lending and other financial products to the last guy standing. UPI's attempt is that we are still only 300 million people, I think, or maybe 400 now. So it still has a long way to go, and yet UPI does like such large volumes is phenomenal.
right,
So payments is sort of in that sense gone to the last man or woman standing in that sense. But a lot of the products, whether it is lending or insurance or wealth, has not reached. We are still an under penetrated country as far as these products are concerned. So if I look at it from some three angles in some ways, one is like I said that we as an industry are under penetrated across maybe lending, insurance, and wealth. The second is the entire mandate that the government had and the entire push from the jam trinity of Jandhan Yojana, Aadhaar, and mobile internet was to take the financial inclusion charter and take it to the last mile. And that's where a lot of the innovation happened with fintechs coming in place. And the third angle, the lens to it is this just the economical part of it, right? So the cost of capital defines in some ways what you can offer as services. So the bank has very low cost of capital, so they're able to say maybe offer lending at say 12, 13, 14, 15%. But then their entire margins are also squeezed, so they want to go after slightly prime customers, people who can who have very low default rates, so largely city based, or if they have physical touch points so that they can keep the cost of default low because they are charging like a lesser interest rate, relatively speaking. And then you have the NBFCs whose cost of capital is a little bit higher, so they can charge a little bit higher interest rate, and then it's fintechs. So the cost of capital also in some ways ended up defining the segment that you went after, right?
Right.
And if you did, and the branches obviously were supposed to do that, and the entire push towards SFBs and other banking structures also was there to push go deeper into the market. But the cost of capital in some sense defines what segment that you go after. So the entire financial inclusion charter also got set economically like that, right? A
Right.
big bank, even though it's a branch, would be there, in a smaller part. But within that, they would like to go after somebody and give them 5 lakh rupees for 5 years. For them, the cost structure will not add up to giving 5,000, 10,000, 25,000 rupees for say 6 months. The
Right.
cost structure won't add up. So if you look at it from all these three angles, rather, one is a government push, one is a technology shift, and the third is cost of capital structure and the financial economical model. It sort of really had been a big, big win for the entire industry to bring a lot of consumers into the formal financial ecosystem, right? I think a lot of these
Right.
guys would go to the informal market or the unorganized market, pay very high APRs, not get recorded formally. So much of fraud used to happen there. A lot of people would, get, very high debt on their ecosystem in their household. So it became a big problem. So the pushing that into the formal financial system helped everybody. Plus, you
Right.
could understand what the guy's income is, you could collect tax, and so on and so forth. So I think that has been a big, big win. What happened, I think, about a year ago was that certain segments, which is maybe like the credit card segment or the slightly shorter ticket size or even microfinance, sort of, it probably grew too fast, and I think the risk weights sort of went up by the central bank. So I think that increased the cost for these products. So I do believe that a lot of these customers who were otherwise coming into the formal financial ecosystem today might be pushed back going into the entire unorganized market, because if they're not going to be able to get 10,000, 20,000 rupee loans, and they may not qualify for 2 lakh, 3 lakh rupees, right? But that does not mean that he cannot pay back 10,000, 20,000 rupees, but he does not have the income to maybe justify a 2, 3 lakh rupee loan. So I guess that's like the little bit of a balancing act that, the industry keeps going through. And I think that's one cycle that we need to see through.
A connected question, Anuj, because you rightly pointed out the way we have been expanding in past many, many years, and we start giving loans to people who could afford it, but they were obviously expensive. Then that has resulted in, and we are seeing a result in many cases on the expensive loans. We are seeing the delinquencies which are picking up, right? Particularly on the unsecured part of the lending cycle, the personal loans and credit cards. Now, if you see this going forward, how do you see this trend evolving, and what are the steps that lenders are taking to manage these kind of risks now?
Yeah. See, I think that there are a couple of concerns that at least we understand. One is, people evergreening on their loans, right? So people are taking so many
Right.
loans that they're taking from one place and paying the other, and that's probably happening in the smaller ticket size. And I think that's genuinely a concern with a large market like ours. A few big players have been driving that for quite some time, and I think a lot of that money might also be going into speculative behavior. Could be going into riskier assets than otherwise. So maybe they're playing a game in gaming world, or it could be going into the stock market, which is probably not necessarily good for the ecosystem. I think these are some of the concerns that have been voiced, and these are all genuine concerns in my opinion as well.
Right.
You don't want to get people to evergreen. You don't want people to take money and then put it into speculative assets, and then once it blows up, it will be a problem. The only and I think that is the reason also why you see delinquencies going up, because if unfortunately one person loses their job, then they're not able to pay one loan. If they don't pay the one loan, they don't get their second one. They can't pay, then they can't take that and pay the third guy. So it became like a little bit of a circular thing, and that
Correct.
was there was some stress that was getting built up. I think the larger stress was probably at least in the microfinance segment and Also in the credit card segment, also because people were taking a lot of money out of the cards rather than just using the card to swipe at merchants, but they were taking the cash out on the cards. So a lot of that was also sort of building up, and that was causing the slightly higher delinquencies in some of these products. The only other thing is that I think that that segment, which is maybe the smaller ticket size that you spoke about, rupee value wise, it's a very small, like 3% odd contribution, while the
Right.
absolute may be quite high. The number of people being quite high, but the rupee value is still small. So I think from a delinquency perspective, it will not impact as much because the contribution rupee value wise is very small.
Correct.
But the number of people getting it is not good. That is definitely a concern area, which is I think why a little bit of a slowdown that you're seeing in the unsecured side. And on the slightly middle class segment, or maybe the guys who earn say 30, 40, 50,000 rupees per month, a lot of the unsecured that they were taking, my belief, and I have no data to prove this honestly, except from what I see on my platform,
Right.
anecdotally from some of the other guys, is that a lot of those guys, 80% of them were probably using it for genuine reasons, like they probably had some emergency in the house, or education, or travel, or whatever else, or even for that MSME thing. So many of our customers, like a tailor bought cloth and then took 5,000 rupees to buy that, and he did something with that 5,000 rupees that we gave him as credit. A contractor bought cement and then did something and earned some money. And the 20% would probably go to speculative assets. So it's like an 80-20 Pareto principle here. But a lot of the customers who were very high income, like people who were earning, say, maybe a lakh or 2 lakh plus per month income, those are the guys who are actually borrowing money to probably put it to speculative assets. And there also the 80
Yeah.
20 rule applies in some ways. Because if they wanted a home loan, they would get a home loan. They want a car loan, they would get a car loan. The only reason why taking an unsecured loan was to put it to speculative assets in some ways. And there also the 80-20 rule applied. Like 20% was genuine, maybe 80% was actually that. So very interesting behavior that, again, this is very, I can't substantiate this with data because we don't get that data. It's very anecdotal. The lesser income guys actually ended up using the short ticket loans for probably for the genuine reasons. But today, when that segment is not growing, so they probably are at the risk of going back into the unsecured, unofficial market, or the money lender, offline money lender market. So that's probably not a good thing, I would imagine. But we'll have to wait and watch.
Anuj, speaking of managing risks, right, the regulators have also been very active in this space. We know the Reserve Bank of India has been implementing policies to temper some of the fast growth, especially in unsecured lending. So, what's your take on how these measures have impacted the industry, and are there any specific policies that stand out in terms of how they're shaping the future of consumer finance?
Yeah, I think like we were discussing, I think a large part of the measures that they have taken is one is around ensuring that the KYC and all of that part is genuine. So there's less
Correct.
fraud in the system. There is,
Less of
as per the
application fraud in that case. Yeah.
application fraud, and so many consumers getting defrauded by fake loan apps. The Chinese loan app scam. I'm sure you covered it as well.
Yeah.
And that proliferated, right? And a lot of NBFCs were just renting out their license and making a quick buck, and this was leading to very high default rates and very aggressive collection practices. So a lot of fraud needed to be cleaned out, and the entire therefore, and KYC was an important part of this to ensure that the right person is getting it at the right time. So I think that was one area of action that they had taken, and just that has genuinely helped the industry. The second area of action that they have taken is that I think they were seeing too much indebtedness happening, and that's the reason why they were maybe putting some curbs and growth on the unsecured market and maybe shorter ticket size, because like I was saying that the rupee value contribution is very less, the number of people is very high, and they were
Right.
seeing people having 4, 5, 6 loans at the same time, which means that a lot of evergreen was happening. So I think those are some of the action that they've taken, and that has definitely put a little bit of a slowdown on the growth of of this segment. But I do think that now that that is played out for some time, hopefully it will, in a responsible manner, come back very soon and very effectively. Because at the end of the day, India is a consumption-driven economy, right? We are 60% of our GDP is consumption-driven, and I think for that to happen, you do need to ensure that the credit is continuously you know oiling the engine in some ways. So doing it in a responsible manner will have to be done. I think those are some of the a lot of people will be thinking about how to do it in a manner which is not causing this evergreening or over indebtedness of the consumers. And I think as long as that is taken care of, I think it will be back very soon. Like I said, my only worry is that with all these actions, if you're pushing the customer to the informal money lending market, then you've not solved the problem entirely because that guy is now taking a loan from somewhere else, which is probably worse off than taking from the formal
Right.
financial ecosystem. So
Right.
it's not an easy thing, but I think that's where the challenge
Yeah.
will be.
Absolutely. Yeah, and that's Anuj, a good segue into the next one because doing regulation is a very fine balancing act, right? It is very easy to go from a very, very wild west to a completely authoritarian way of doing things
Yeah.
where it starts stifling innovation. So, considering the way things are moving right now, do you think it is going to become a bit more challenging to innovate while also ensuring that we are or a company is aligning with the regulatory compliance is required? Or do you think it is just the right level of regulation that's currently in picture?
I don't know if I could say it's the right level because now we've seen a few cycles the last 5 6 years. So every time
Yeah.
you believe that this is the right cycle, then something else happens. So I don't know how to I don't know how to qualify that. And I think that it is a tough job because they are also reacting to what's happening in the market, right? So
Correct.
if a
Correct.
lot of the
True.
signs were not that somebody is doing fraud, then they would not have taken action A. If a lot of the signs were that people were not taking 5 or 6 concurrent loans and evergreening, they would not have taken action B. So they're also reacting to in some ways to the data that's being presented to them. And I don't think they also know that this is the right level or not. For example, right? As long as as long as the industry is growing in a healthy manner, I don't think they'll have a problem. I do think that they are a pretty proactive regulator in the sense that they do a lot of these sessions with industry bodies, like setting up an SRO as well. So a
Right.
lot of that discussion will get channeled through them, and that you could do it in this way, or you could do it in that way. So they do take some feedback from that perspective, but they will have to come up with some solution or the other. I mean, at the end of the day, maybe this is sometimes for them it's easier to say that first let me clean it out and then let me make it open again, so that when the
Mm,
reopening happens, it happens in the right manner, because otherwise it's very difficult to manage it. So I do think
Right.
that's what we're seeing right now. Like I said, that if we have to grow from a GDP perspective, consumption is important. For consumption, you do need to get a little bit of credit growing, and we are underpenetrated as far as that metric is concerned, and not just credit, like insurance as well, for that matter as well. So I think those metrics do need to go up, and for that, the regulator probably will view it in a different light. Maybe they reduce some cost of capital for the industry. Maybe they reduce the risk weights that had gone up, but they probably will not do it across the board, right? Like for example, they had increased the risk weight in a few segments, like credit card, for example.
Correct.
So that is different. If they don't see the data of delinquency coming down there, then maybe they will not do it there. For example, microfinance, maybe they'll see it there a little bit. So that is, they will take a little bit of a maybe sectoral view from that perspective.
Anuj, finally, before we wrap up, we'd love to hear your thoughts on how you think this entire consumer finance space will evolve in the near future. Would you see more and more players in the space start also looking at complementary products? And what do you think would be the impact if something like credit line on UPI actually became available to digital finance companies as well?
Two big questions, actually.
Yeah.
So I think this confluence of all the other verticals is a real thing. We definitely are seeing that at Freo, beyond just lending, which is where we started off and we focused on, right? So you do one thing right, and then you start figuring out how can you add other stuff, other products, so that you are able to generate better ARPU, you're able to hold the customer better and ensure that the customer has all their financial needs done on one platform. It gives you better ARPU eventually for the customer. So and all these three things, which is lending, insurance, and wealth, are underpenetrated in the country. Payments also to some extent, but still very, very omnipresent thanks to UPI. So unless and until you figure out a right mix or right intertwining of them, you also don't want it to dilute the value proposition to the customer. The customer should be very clear, I'm coming to you for A, B, and C. If they keep getting conflicting messages, then it becomes a little bit of a challenge. So it's not so straightforward how to do it. But given that everybody's been doing one thing good, they've got a large customer base. They should be able to sell various different products to the same customer if there's trust being built up to product A. It's no different from any commerce platform. Right? Everybody starts with say mobile phone category, then they add a home category, then they add something else, and then groceries. And it's just that you build the trust with the system that it works for me. Maybe I can sell them or at least ask the customer if they want something else, and we will deliver with the same trust and efficiency that we can. And it definitely helps the bottom line because you don't have to spend money to acquire the customer again. So the CAC is definitely lower for that customer. So the benefits are immense. There's definitely a theme that's been playing out with all these three or four things intertwined. So I think that's going to stay for the next 1 or 2 years. The second part, which is credit on UPI, I think I'm very, very bullish on that piece. That product has the ability to really take it to the masses, right? I think when we used to do this product in its earlier avatar, we moved from some 80 cities to 1200 cities, and we were able to give people 500 rupees, 1000 rupees, and they were not going into gambling for that matter, right? They were people wanted to buy fuel, wanted to buy groceries. You go down to a tier 3 market today, and the person wants to buy groceries. He or she cannot pay at the end of the month. They have to pay then and there. The Kirana store is doing a quick credit assessment by looking at you and saying, should I give this person credit or not? And I'm sure that, all of us on this call, we also buy groceries and then the guy comes to deliver at our house. If it's the neighborhood grocery guy, and then we'll say, lik dena. And then, oh, month end may he will come and then we'll pay him back, right? So he's done some
Right.
credit
Yeah.
assessment to say that these guys are not going to go away. ये लोग हमारा पैसा दे देंगे. And it is of 0% interest. We're not paying anything extra for that. So if I, who does not need it, can get this, the real person who needs it on the ground, they don't get it because credit cards have not reached there. So, and UPI is omnipresent, right? QR codes everywhere. So credit on UPI can solve that. And if done in the right responsible manner with the right process, right credit underwriting, right KYC, bureau check, fraud, etc., etc. And now with auto pay on UPI, you don't have to set up. It's very easy to set up the auto pay for that matter. You can give 1,000, 2,000 rupees to the large masses, even though the income is low. Maybe he or she can only afford 2,000, 3,000 rupees or 1,000 rupees. So I do think that's going to be a big, big, big play to bring all these guys into the formal financial ecosystem. We are, like I said, we have done this in the past, but then various different reasons we had to stop it. And we are now waiting for the RBI to allow NBFCs to allow credit on UPI. We have our own UPI license, and once the NBFCs are allowed, we have our own NBFC license as well, or we partner with other NBFCs. My only request is that you should allow it to function just like any other partnership will, because the fintechs have the ability to take it to the masses and underwrite, but they need the help from the balance sheet with the NBFC partnerships. So if you make it very restrictive, then it probably will not grow. So that's my only request to the central banker, that allow it to happen with NBFCs, and there is a way that you can take it to the masses and do it in the right manner and do it in a responsible manner without over leveraging the customer, and keeping delinquencies low, because we have found that in that product the need is very high, and it's a genuine need, and that's the reason why people pay back, because they understand that if they don't pay back, they will not get this access to the credit, right? On UPI. And you don't have to teach the people how to do UPI because they all know that, and it's just coming from a credit account. So I mean, this has been said enough in the open market, but I do think that that can be a significant game changer once it's been introduced.
Absolutely, Anuj. And on that positive note, and hoping someone from NPCI and RBI is listening to this episode, we would like to end this episode. Thanks a lot, Anuj, for joining us today. It was a pleasure having you on this. chat.
Thanks, guys. Thanks, Iman. Thanks, Roy.
That's it from India FinTech Diaries this week. Do log on to our website, indiafintechdiaries.com, for show notes and other exclusive content. If you have enjoyed this episode, don't forget to subscribe and stay tuned for more discussions on the latest in India FinTech. Until next time, stay safe.